If you've got money sitting in a savings account and you still believe it's only a little bit of interest, nobody at HMRC is ever going to notice, you are exactly the kind of person this new bank rule is most dangerous for. Not because you've done anything shady, not because anyone thinks you're laundering money, but because the people who get hit hardest are usually the calm, responsible, ordinary savers who assume the system will sort itself out, and it won't. In fact, the more sensible you think you're being, the easier it is to walk straight into the trap. Because this isn't really about your bank balance. It isn't even mainly about your bank account. It's about the data attached to that account, how that data reaches HMRC, and what happens when the numbers on your side and the numbers on their side don't line up neatly. And the part nobody explains clearly is that the danger doesn't begin when you earn a fortune in interest. It begins the moment you stop paying attention because you think the amount is too small to matter. So in the next few minutes, I'm going to show you what this rule actually is, why so many people misunderstand it, why more savers are now drifting into HMRC's line of sight without realizing it, and most importantly, how to make sure your money tells a clean, boring, consistent story before the tax system tells one for you. And once you see the one detail that really matters, you'll understand why so many people get blindsided by letters they never expected to receive. Now let's clear up the biggest misunderstanding first, because if you get this wrong, the rest of the conversation becomes useless. A lot of people talk about HMRC and banks as if there's some person somewhere staring at your account in real time, watching every transfer, every deposit, every move you make. That's not the useful way to think about it. The real issue is more mechanical than dramatic. Banks and building societies in the UK already provide HMRC with information about interest paid or credited to customers. That's not rumor, that's built into the system. And the reason that matters is not that HMRC knows you exist. Of course they know you exist. The reason it matters is that the reporting is getting better, cleaner, easier to match, and harder for ordinary mistakes to hide inside. And here is where the new rule changes the game in a way most people still haven't absorbed. The amount of savings interest you earn has already been shared with HMRC, but one of the recurring problems has been matching that data to the right person cleanly and accurately. In plain English, not all third-party bank data is easy to read or easy to connect to the right tax record. The planned change is designed to make banks provide more reliable identifying information, including national insurance numbers for many traditional savings accounts, so HMRC can match interest to taxpayers more accurately. That sounds technical, it sounds dull, it sounds harmless, but dull administrative changes are often the ones that quietly change people's lives because they remove friction from enforcement. And that is the first thing I want you to understand. This is not some dramatic headline rule where your bank suddenly starts snitching on you next Tuesday. The bank has already been reporting interest data. The shift is that the system is being tightened so that mismatches become harder, excuses become weaker, and forgotten savings interest becomes much easier to connect to a real person. In other words, the fog is lifting. And if you've been relying on fog, even accidentally, that should concern you. Now, once people hear that, they usually jump to the wrong fear. They think, so HMRC can see everything. Not exactly, and this distinction matters. This does not mean an HMRC officer is studying your weekly grocery shopping, judging your coffee habits, or monitoring your current account like a reality show. What it means is far more specific and in some ways more dangerous because it feels so easy to dismiss. Financial institutions submit information about interest. HMRC uses that information to pre-populate tax records, check tax calculations, and compare what's been reported by third parties with what you've declared yourself, if you've declared anything at all. That sounds manageable until you realize how many people have absolutely no idea what interest has been reported in their name across multiple accounts. A savings account you opened years ago, a second account you used for an emergency fund, a joint account that pays interest, a fixed rate bond you forgot to include in your mental total, a decent cash pile sitting there while rates rose. None of that feels dramatic when you look at each piece separately, but tax systems don't care how each piece feels, they care what the total says. And that brings us to the second misconception, which is probably the most expensive one. People hear the phrase personal savings allowance and assume it protects them automatically. They hear up to £1,000 of interest and mentally file the whole issue under not my problem. But the allowance is not a magic invisibility cloak. It's a threshold that depends on your tax band. If you're a basic rate taxpayer, you may have up to £1,000 of savings interest tax-free. If you're a higher rate taxpayer, that drops to £500. If you're an additional rate taxpayer, you get no personal savings allowance at all. So the exact same amount of interest can be irrelevant for one person and tax triggering for another. And here's where the emotional trap begins. Most people do not feel rich when they trip this. They feel normal. They feel like they're simply doing the prudent thing. Maybe rates went up. Maybe you built a bigger cash buffer. Maybe you sold something, downsized, inherited money, or parked cash while deciding what to do next. You're not thinking, I'm entering a tax risk zone. You're thinking, I'm finally being financially responsible. But the tax system doesn't care how noble your intention was. It only cares whether the interest crossed the line for your band and whether the record on your side matches the record on theirs. And before we go any further, let me tell you the part that catches mature savers especially hard. This doesn't only hit people with huge portfolios and accountants. In fact, some of the people most vulnerable are retirees, cautious savers, self-employed people with money held back for tax, and anyone who has built up cash because they don't trust the market. These are not reckless people. These are often the exact people who pride themselves on order and discipline, which is why the surprise feels so personal when a coding notice changes, a letter lands, or a tax bill appears from money they never thought of as income in the emotional sense. Because that's the real psychological problem. Interest feels passive. It feels incidental. It feels like background noise. You didn't clock in for it. You didn't invoice for it. You didn't actively earn it in the way you earned a salary, so your brain files it under bonus instead of tax item. HMRC does the exact opposite. To them, savings interest is data, and data belongs somewhere. If it doesn't land where it's supposed to, the mismatch becomes the story, and the story matters more than most people realize. Let me show you why. Under the current reporting framework, banks and building societies can be required to provide HMRC with annual information about interest paid or credited. There is a reporting cycle to this. The tax year runs from April 6th to April 5th. HMRC issues notices. Institutions submit returns. Records are kept. This is not improvised. It is not casual. It is structured. So when people imagine that undeclared or forgotten interest just sort of slips through because the government is too busy, they're picturing a much sloppier machine than the one they're actually dealing with. Now add the coming improvement in identification, and you can see what's happening. The state doesn't need to invent a new superpower. It just needs cleaner matching. Cleaner matching means fewer gaps. Fewer gaps mean more people getting the "you owe tax on savings interest" conversation. And that doesn't always arrive as a dramatic accusation. Sometimes it arrives quietly through your PAYE tax code, sometimes through a calculation, sometimes through a nudge letter, sometimes through a correction that makes you feel, wait, where did this come from? And because it feels small and administrative, people often mishandle it in exactly the way that makes the problem worse. Here's the next misconception. People assume that if the bank reported it, then the tax must already have been taken care of. That used to be a much more intuitive assumption because older generations remember a world where many financial things felt more automatic and more contained. But reporting and settling are not the same thing. The bank providing information to HMRC does not mean the final tax position has magically resolved itself in your favor. It means the information exists in the system. Whether your tax is correct depends on what else is true about you. Your income, your tax band, your other accounts, your self-assessment position, your code, your timing, your total interest across institutions. One piece of data does not finish the story, it starts it. And that is where a lot of well-meaning people lose control. They see one account statement and think one account story. HMRC sees a wider picture than that. Not always perfectly, but increasingly well enough. If you had £200 of interest here, 300 there, a fixed rate account that matured, and another account you barely remember, you may still mentally treat each pot as harmless. The system is built to total them. Let me give you a real-world type of example, because this is where the problem suddenly becomes obvious. Imagine someone in their early 60s. Mortgage nearly gone. A good chunk of cash sitting in savings because they want security more than risk. They've spread that money across several accounts because every bank has a different rate and every money-saving article says shop around. Sensible behavior. Perfectly sensible. Then rates rise, and suddenly those accounts start producing meaningful interest. Not fantasy wealth, just enough to matter. Maybe they're a higher rate taxpayer because of pension income plus part-time consulting, or maybe a one-off event nudges them into a different tax position than they expected. They don't feel wealthy, they feel careful, but careful people can still walk right over a threshold if they stop counting. Or take a self-employed person who keeps money aside for VAT, corporation tax, income tax, or a future payment on account. That money sits in easy access savings because why leave it earning nothing? Again, sensible. But the interest on that money still counts. And if that person is already filling out self-assessment, the danger isn't just that HMRC can see more of it. The danger is that HMRC can compare what was reported by the institutions with what ended up on the return. If those numbers diverge enough, you've created a question where you thought you had created efficiency. And there's an even crueler version of the problem. A lot of people are being dragged into this not because they suddenly became brilliant savers, but because frozen tax thresholds and higher interest rates have done the heavy lifting for them. In other words, you don't need some dramatic financial transformation to become newly exposed. You just need the same habits in a changed environment. That is why so many people are caught off guard. They are using yesterday's assumptions in today's numbers. Now, here is the part people really don't like hearing. The trap is not only failing to declare something when you were supposed to, the trap is also the casual way people talk about it. They joke that HMRC can't possibly care. They say things like, it's only a few £100. They assume the system won't bother. They believe small errors are invisible by default. But small doesn't always stay small. Small repeated across years becomes a pattern. Small combined across accounts becomes a total. Small attached to the wrong tax band becomes a liability, and small, once identified by a better matching system, becomes easy revenue. That's why the emotional framing matters. If you see this as a massive criminal issue, you panic unnecessarily. If you see it as trivial admin, you ignore it carelessly. The truth sits in the middle. This is not a story about HMRC storming your house because you earned a bit of interest. It is a story about ordinary people sleepwalking into friction with a system that is getting better at connecting dots. So let's talk about the rule in the plainest possible terms. Banks and building societies already send HMRC annual information about savings interest. A new tightening of that reporting system is aimed at improving identification by requiring more reliable personal data, including national insurance numbers for many traditional savings accounts, so the interest can be matched more accurately to the right taxpayer. The purpose is obvious: fewer errors, fewer mismatches, easier collection, less room for people to say they didn't realize. That's the essence. Not cinematic, not flashy, just quietly effective. And because it's quietly effective, people underestimate it. Now let me show you where the biggest mistakes happen, because understanding the rule is useful, but knowing where real people mess up is what actually protects you. The first mistake is assuming ISAs and regular savings are basically the same in HMRC's eyes. They're not. Tax-free wrappers matter. If your money is inside an ISA, the interest is tax-free. If your money is in an ordinary taxable savings account, different story. The problem is that people often remember the word savings and forget the wrapper. They think, my money's just in a bank. But the tax treatment depends on where it sits. When people move money around chasing rates, that distinction gets blurry in their mind. A tax-free pot over here, a taxable pot over there, same bank, same app, very different consequences, and if you confuse those in your own head, you can be sure the eventual letter will feel unfair even when the system thinks it's being perfectly logical. The second mistake is assuming current accounts are irrelevant. Now, the coming reporting change has been described around traditional savings accounts rather than tax-free ISAs and not specifically current accounts in the same way. But here's the practical point. If an account pays taxable interest, you still need to understand what is happening. Don't hide behind labels. Current account does not automatically mean ignore forever. The label on the product is less important than whether taxable interest exists and whether it contributes to your yearly total. The third mistake is failing to total all interest across all institutions. This is the killer. One bank pays a little, another pays a little. A bond matures, a joint account chips in. You glance at one statement, feel reassured, and stop there. But HMRC doesn't care which bank you emotionally identify as your main one. It cares what the combined information says, and combined is where people get caught. The fourth mistake is believing that because you've never received a letter before, you must be below the radar. Past silence is not proof of future safety. It may simply mean the data was not cleanly matched, the timing hadn't caught up, the amount didn't trigger a process yet, or the issue has not surfaced. That's why cleaner identification matters so much. It changes not only what can be seen, but how confidently it can be linked to you. And the fifth mistake, the one that feels the most innocent, is thinking you can deal with it later when later arrives. That is where stress explodes. Because the moment HMRC's version of the story shows up in writing, people start reconstructing old interest totals from memory, trying to remember which account paid what, whether that one was inside an ISA, whether the closed account still exists, whether the maturing bond pushed them over the line 2 years ago, whether the tax code adjustment is right, whether they should amend something, ignore something, call someone, or panic. What could have been a 10-minute annual review turns into an exhausting archaeology project through your own finances. And this is exactly why mature audiences, especially people who pride themselves on being tidy, find this so upsetting. It feels beneath them. It feels administrative. It feels like the kind of thing a competent adult should never get wrong, which is why they delay facing it. Shame and complexity make a terrible combination. So let me remove the shame from it. The system is not intuitive. Nobody naturally thinks about interest the way the tax system thinks about interest. The average person thinks in jars: emergency jar, house jar, tax jar, rainy day jar, family jar. The tax system thinks in totals. That difference is the whole problem. Now, the good news is that the fix is much simpler than the fear. You do not need a tax lawyer, a spreadsheet obsession, or a dramatic overhaul of your life. What you need is a boring annual ritual, and boring is exactly what protects you here. First, know which accounts are tax-free and which are not. That sounds embarrassingly basic, but it is astonishing how many people cannot answer it quickly for every account they hold. If you can't say, with confidence, that one is an ISA, that one is not, that one is a regular saver, that one pays interest I need to count, then you're operating on vibes, not facts. Second, total your interest across all taxable accounts once a year, not the balances, the interest. This is where people drift off course because they admire the size of the pot and ignore the tax relevance of the yield. Your balance is emotionally interesting. Your interest total is tax interesting. Those are not the same thing. Third, compare that total with your tax position, not your feelings. If you're a basic rate taxpayer, your allowance is different from a higher rate taxpayer's. If your circumstances change during the year, your assumptions might be outdated. If you're self-employed and filing self-assessment, this matters differently than if you're employed and taxed through PAYE. The tax system does not care that you thought you were probably under. Probably is not a strategy. Fourth, keep a simple record, not a masterpiece, not an accountant's file. Just a clean note you can understand a year from now. Account name, tax year, interest earned, whether it was inside an ISA or not, and whether it was included in your return or your own calculation. That single habit gives you something most stressed people do not have when a question lands: a clean narrative. Fifth, never assume a bank statement buried in an app is the same as having a system. A statement is a document. A system is knowing where the relevant numbers live before you need them. Those are different things. When people say, I have all the paperwork somewhere, what they usually mean is, I have future stress stored digitally. And now let's talk about what actually happens if you do cross the line, because I want to kill two extreme reactions at once. Reaction number 1 is denial. Surely they won't bother. Reaction number 2 is panic. I'm finished. Usually the reality is neither. If you owe tax on savings interest, the mechanism might be a tax code adjustment, a calculation, a request to pay, or an issue raised through self-assessment. It is often administrative before it is dramatic, but administrative problems become expensive when ignored, and fixable problems become ugly when handled emotionally. That's why the next rule matters so much. If HMRC writes to you about savings interest, do not wing it. Do not fire off a defensive explanation from memory. Do not reply based on what you think one account did. Pull the actual numbers first. The fastest way to turn a tidy correction into a messy back and forth is to answer confidently before you understand your own figures. And please don't make the classic move of telling yourself, "I'll wait and see if they send another letter." That mentality is how small issues become accumulated stress. The right way to think about these notices is this: they are not moral judgments, but they are opportunities to either restore clarity or compound confusion. Your goal is not to feel innocent, your goal is to be documented. That sounds cold, but it's liberating once you accept it, because the system does not reward outrage, it rewards consistency. If your records are clear, your response can be calm. If your records are sloppy, even a small issue feels like an accusation. Let me give you the practical script, because this is the part nobody ever hands people. If you discover you've earned more taxable interest than you thought, you don't need drama. You need sequence. Confirm which accounts generated taxable interest. Pull the year-end figures, total them, check your tax band, check whether the amount was already reflected in your tax code or return. If not, address it directly, calmly, cleanly. The power move here is not cleverness, it's order. And if you're thinking, fine, but why does this feel like it's coming for ordinary savers all of a sudden? Here's why. Interest rates changed. Cash became productive again. More people held more money in savings because of uncertainty. Frozen thresholds meant more people were nudged into tighter positions, and HMRC wants cleaner third-party data so it can collect what the law already says it's owed. That combination is why the issue now feels bigger than it did a few years ago. The public story is about fairness and reducing error. The lived experience for many people will be, why am I suddenly hearing about this now? Because the system became worth listening to. So, what is the one mindset shift that keeps you safe? Stop thinking like a saver only. Start thinking like a saver whose data gets totaled elsewhere. The money itself is not the only thing that matters. The reporting trail matters. The classification matters, the annual total matters, the match matters. Once you understand that, everything becomes much easier because you stop relying on hope and start relying on records. And here is the ironic part. The people who sleep best are not necessarily the people with the least money. They are the people whose money makes the least confusing story. That's what you want. Not secrecy, not complexity, not cleverness. A boring story. A story where every pound of interest has a home, every account has a label, and every year has a simple total attached to it. That is how you stay out of unnecessary friction. Before I finish, let me give you the 5-minute action step that can save you hours later. Open OneNote on your phone, your computer, or a piece of paper if that's your style. Call it taxable savings interest. Then list every account that can pay interest. Put a mark next to the ones that are ISAs. Put another mark next to the ones that are taxable. Once a year, add the actual interest from each taxable account and write the total at the bottom. That's it. Not glamorous, not complicated, but once you've done that, you stop being the person who says, "I'm pretty sure I'm fine," and become the person who knows. And in this area, knowing beats guessing every single time. Because the real danger was never that HMRC suddenly became interested in you personally. The real danger was that you assumed a modern reporting system would stay fuzzy forever, while your savings quietly became more visible, more valuable, and more taxable than you realized. That's what this new bank rule changes. It removes blur. It sharpens identity. It makes the data cleaner. And cleaner data means less room for ordinary people to drift through on outdated assumptions. So don't be frightened by it, but do respect it. Don't act like a criminal. Don't act like a victim. Act like an adult who understands that if the system is going to total your interest, you should total it first. That one habit takes away most of the sting. If this helped you see the issue more clearly, pass it to someone who still thinks savings interest is too small to matter, because that sentence is going to age badly for a lot of people. And if you've ever been surprised by a tax code change, an HMRC letter, or a savings figure you didn't realize counted, I want to hear about it in the comments, because those real situations are where the next important lessons usually come from. I'm Henry, this is Henry Wealth Blueprint, and I'll see you in the next one.